Welcome to the deep dive. If you're trying to build wealth and allocate capital in January 2026, you know the environment is anything but straightforward. We are navigating a difficult intersection of economic forces.
Yeah, it's tricky out there. The echoes of post-pandemic inflation are still audible. The cost of capital has been fundamentally repriced from that whole free money era.
And on top of all that, geopolitical competition has crystallized into a very complex and frankly expensive 2025 tariff regime.
It's an environment that demands rigor. I mean, the speculative bets that worked so easily during the zero interest rate period, they've just vanished.
Right. As the saying goes, the tide has gone out, and we are now desperately searching for companies that haven't been swimming naked.
Exactly. Businesses with genuine structural durability built on, high barriers to entry and predictable revenue.
Our mission today is focused entirely on that durability. We are not chasing the next big growth stock. We are looking for a reliable, quiet compounder that operates a bit beneath the radar, and we think we found it in Agilent Technologies, ticker A.
That's right. They are the essential infrastructure provider, the picks and shovels for all modern science.
Manufacturing the analytical instruments found everywhere from massive pharmaceutical R&D labs to regulatory environmental testing centers.
Agilent is essentially the engine room of global scientific compliance and discovery. Our deep dive today is going to be forensic. We need to dissect why they possess such high-quality revenue.
Focusing intensely on their management stewardship, the economic moats that protect their business model.
And critically, how they are actively navigating the most significant external financial challenges they face, specifically those new 2025 tariffs, which are actively pressuring their margins.
Before we jump into all the details, let's set the stage with the current metrics. As of today, January 16th, 2026, Agilent's share price is sitting at $144.92.
Which gives the company a market capitalization of approximately $42.4 billion.
And here's the core thesis we will be working toward today. Our research indicates Agilent is undeniably a high-quality name, a true compounder.
But, and this is the important part, it is currently trading slightly above our conservative estimate of intrinsic fair value, which we calculated at about $140 per share.
So what does that mean in practical terms?
It means it merits a core hold designation for existing long-term investors. Don't sell it. However, the real opportunity for new capital opens up if volatility drives the stock down into a compelling accumulation range, which our model pinpoints between $125 and $130.
Okay, let's unpack this high-quality compounder. We have a lot of dense research material covering everything from global supply chain risks to detailed balance sheet metrics, and we're going to walk you through all of it. Part 1, chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding.
So to truly appreciate the business quality of Agilent today, you have to first understand its foundational pedigree. It's not just some standalone industrial company. It has a rich technological history.
It's that original Silicon Valley startup lineage, right? Agilent was famously spun off from Hewlett-Packard, HP, back in 1999.
Precisely. And that history isn't just a footnote. It is the embedded culture. They retained that enduring HP way ethos, which is built on, deep engineering excellence, rigorous operational discipline, and a fundamental focus on long-term shareholder value.
They're structurally engineered, not speculatively built.
That's a great way to put it. And what they manufacture, the instruments, are anything but discretionary. They are mission critical across the entire life sciences industry, from the pursuit of new drugs to ensuring environmental compliance and monitoring the global food supply.
And their evolution has been key to their success. Historically, a lab was, a siloed collection of expensive, complex machines?
Exactly. But today, Agilent has successfully pivoted. They are no longer simply a hardware seller. They are a workflow-centric partner. They're positioning themselves as the provider of the digital ecosystem that manages the entire data pipeline within the lab. This is a critical shift, and it's really what underpins their economic durability.
Okay, let's get into the mechanics of that durability. The installed base or annuity business model is the classic razor and the blade, but applied to high-tech analytical science, which makes it extremely sticky.
Absolutely. The razor is the instrument segment. These are the high-end machines, liquid chromatographs, or LC, gas chromatographs, GC, mass spectrometers.
The big boxes.
The big, expensive boxes. They are major, capital-intensive purchases, costing anywhere from $50,000 to well over $500,000 per unit. In fiscal year 2025, Instrument sales accounted for about 34% of their total revenue.
And that 34% is the cyclical part of the business. When pharma companies or government labs tighten their belts, they delay those big capital purchases.
Correct. But the blade, the consumables and services, that is where the real stability comes in.
This is truly where the magic happens for the long-term investor.
It is. Once that Agilent instrument is installed and validated, the customer is deeply locked into the ecosystem. They have to continually purchase highly specific proprietary parts, chromatographic columns, standardized reagents, sample prep kits,
All the stuff that runs out.
all the stuff that runs out, plus essential spare parts just to maintain operation. And on top of that, because these tools are used in highly regulated environments, think FDA drug manufacturing, they require mandatory, consistent calibration and robust service contracts to maintain their compliance certification.
And that predictability and recurring nature must carry some incredibly high margins.
It does. It provides a massive, high-quality, high-margin buffer against macroeconomic headwinds. If we look specifically at the FY 2025 performance, total revenue reached $6.95 billion.
Okay.
And the growth from that recurring revenue segment was robust, driving a reported plus 6.7% of the total growth. That cushions the cyclical downturns we saw in the instrument segment earlier in the year.
Now that we've established the overall model, let's break down the structure. Post-reorganization in November 2024, Agilent operates via what you termed the three-legged stool 3 specialized operating segments.
Correct. We have the three segments, and each one contributes differently to the overall stability and growth profile of the company. We can start with the Life Sciences and Diagnostics Markets Group, or LDG.
Okay.
This is their core instrument platform, heavily focused on LC and MS systems used for separation and precise identification of complex molecules.
So these are the machines involved in cutting-edge R&D. Who are the primary buyers in this space, and why is this segment such a strong signal for us?
The primary customers are pharmaceutical and biopharmaceutical giants. If you are researching, developing, or running quality control on a complex new therapeutic, whether it's the next generation of GLP-1 weight loss drugs or advanced antibody drug conjugates for cancer, these machines are absolutely mission critical.
So this segment gives us a direct proxy for the health of the broader pharma capital expenditure cycle.
Exactly. And right now, the signal is powerfully positive. LDG reported Q4 FY 2025 revenue of $755 million, which represents a substantial 15% reported increase.
Wow, 15%.
That surge confirms a clear turning point. It suggests that the 2023-2024 biotech winter, which was characterized by labs running down inventory and delaying purchases, is definitively over. Capital is flowing back into R&D and manufacturing capacity.
Okay, next up is the Agilent CrossLab Group, or ACG. You called this the core annuity stream. Why is the segment so structurally superior?
The Agilent CrossLab Group is the long-term investor's dream because it houses services, consumables, enterprise software, and enterprise asset management. They are not just focused on selling you parts for your new Agilent machine.
Right.
They're focused on selling uptime and operational efficiency for your entire lab.
And I think we need to reiterate this point. They managed competitors' equipment too.
That is the essential moat builder. Imagine a sprawling multi-million-dollar R&D facility. It has hundreds of instruments from multiple vendors, Agilent, Thermo Fisher, Waters, maybe even some custom gear.
It's total mix.
ACG steps in as the single strategic vendor, managing all preventive maintenance, calibration, certification, and compliance documentation for everything. This integration is what creates immense logistical switching costs. They become indispensable.
So once ACG is integrated into a lab's entire operation, tearing them out would be a managerial nightmare. It functionally cements Agilent's place as a strategic infrastructural partner.
Precisely. ACG reported Q4 2025 revenue of $755 million, showing a reliable 7% reported growth. Now, while that 7% is lower than the 15% jump in instruments, the quality of that 7% growth is gold.
It's predictable.
It's predictable, recurring, high margin, and highly defensive. It's stabling this as the entire company through any economic turbulence.
And that completes the structure. We have the Applied Markets Group, or AMG, the steady cash flow generator.
Right. AMG focuses on older, more durable technologies like gas chromatography, spectroscopy, and vacuum tech. Their markets are, a bit less glamorous. Chemical analysis, energy, food safety, and environmental testing.
But these are highly regulated segments. If a municipality needs to test their water supply for dangerous PFAS chemicals, or if a food manufacturer needs to verify against contamination, that testing is mandatory.
Exactly. It's regulatory mandated. So in a recessionary environment, when that LDG instrument segment might see some cyclical weakness, AMG provides the floor.
These aren't discretionary purchases, they are compliance requirements.
Exactly. That regulatory mandate ensures a reliable, steady cash flow, which is crucial because it reliably funds the significant R&D expenditures needed in the faster-growing, more innovative LDG segments. It's a beautifully diversified portfolio designed for resilience.
Let's shift to the core competitive advantages, the wide economic moat. The source material is adamant that Agilent's moat is built on regulation and integration.
The moat has three powerful pillars. Let's start with the most formidable one. Regulatory switching costs. We call this the file and forget phenomenon for a reason.
Unpack that process for us. Why is validation so critical and so sticky?
Okay, think about the process of drug approval. When a pharmaceutical company prepares a new drug application for the FDA, they must document every single step of quality control and manufacturing.
Every detail.
Every single detail. So if they used a specific Agilent instrument, say the 6470 triple quadrupole mass spectrometer, to perform a key purity assay, that specific method, run on that specific model, is now written into the legal regulatory filing.
So if a lab manager later decides to try to save some money by switching to a machine made by Waters or a Chinese domestic competitor, what's the real consequence of that?
The consequence is massive risk, cost, and delay. Switching vendors requires a full, rigorous, and extremely time-consuming method revalidation, which can take months and cost hundreds of thousands of dollars just to prove to the FDA that the new machine yields identical, compliant results.
And given that the drug has a 20-year patent life, they are not going to risk their entire revenue stream just to save, what, 50 grand on a piece of hardware?
No pharmaceutical executive in their right mind would risk that regulatory scrutiny. Once Agilent wins that initial R&D slot and the drug is approved, they're effectively locked into servicing and supplying that company for the life of the drug, 20 years or more.
That is an incredible moat.
It creates a deeply entrenched, non-negotiable switching cost that is the envy of the industrial world. The second pillar is the installed base network effect. Agilent's sheer scale, an installed base of approximately 285,000 laboratories worldwide, creates a powerful, self-reinforcing feedback loop.
The standardization factor.
Exactly. It begins in academia. University chemistry and biology students train on Agilent hardware and their open lab software platform. When these highly trained scientists graduate and enter the industry, they push for the equipment they are already familiar with.
It just makes everything easier.
It facilitates easier training, simpler data sharing, and standardization across large global companies that want minimal friction. Agilent becomes the de facto safe choice.
And the final pillar?
The final pillar is scale economies in R&D. Agilent protects its technological lead by maintaining heavy, consistent R&D expenditure, investing billions into developing next-generation platforms like the Revident LCQ TOF or the new 8850GC system.
And smaller competitors, even focused ones like Waters, just can't sustain that kind of pace across a global service network.
They cannot. R&D spending in this field is an arms race. Agilent can launch a technologically superior mass spectrometer and simultaneously maintain a global service network supporting 250,000 customers. That's a feat that just breaks the business model of smaller, more niche players. This protected R&D spend is the fuel that keeps the moat wide.
That R&D effort feeds directly into the Ignite strategy, which you mentioned is their digital pivot. This isn't just about selling better hardware, it's about shifting the focus to selling intelligence and infrastructure.
The Ignite strategy is mission critical for their long-term valuation. The ultimate goal is the fully connected digital lab. Historically, a great deal of a scientist's time was wasted on manual data transcription, checking instrument logs, and troubleshooting.
Right.
Agilent is connecting all its instruments to the cloud and deploying AI and machine learning to automate workflows and optimize uptime.
We need more detail here. Beyond simply connecting instruments, what specific SaaS-like products are they offering that truly increase stickiness and displace competitors?
The Smart Alert system is probably the most relatable example. Instead of relying on a scientist to notice a subtle change in pressure or temperature, the AI models are trained on failure data. They can predict an impending vacuum pump failure on a mass spectrometer, which can be catastrophic for a high-value experiment.
And automatically trigger a proactive maintenance request through the CrossLab group.
Exactly, but it goes deeper. They are rolling out integrated data management and compliance software that sits above the hardware. This suite, often branded under Open Lab, allows seamless data centralization and audit trail generation across multiple devices, often displacing legacy, custom-built, or competitor data systems.
So that transition is turning what was once a transactional hardware sale into a subscription-like relationship.
It is. It's deepening those switching costs significantly and creating entirely new recurring revenue streams.
That pivot transforms them from a box seller to a compliance solutions provider. But they don't operate in a vacuum. Let's talk about the competitive landscape. They are fighting some formidable giants.
The competition is fierce, and they have to contend with three distinct types of rivals. First, Thermo Fisher Scientific, TMO, the Walmart of science, with a market cap over $230 billion.
Their threat is scale and sheer breadth. They offer everything.
They do. Thermo Fisher is the bundler. They can equip a lab from floor to ceiling and offer significant discounts for doing so. Agilent counters by positioning itself as the premium specialist, offering higher performance analytical instruments and a demonstrably superior user-friendly software usability layer. They aim for quality over quantity.
Okay, who's next?
Second, we have Danaher DHR, masters of M&A and process, valued at over $168 billion.
Danaher's strength is the legendary Danaher Business System, DBS, focused on relentlessly optimizing acquired businesses. They own SCIEX, a strong competitor in mass spectrometry.
They do, and Agilent competes here on integrated workflows. Danaher often operates through a portfolio of acquired brands that are sort of stitched together. Agilent offers a more seamless integrated solution from chromatography to mass spectrometry, which is highly valued by scientists who need robust, repeatable data without integration friction.
And the last one.
Finally, Waters Corp, Watt, the pure-play rival, around a $22 billion market cap.
They are a direct competitor specifically in high-end liquid chromatography and mass spectrometry.
Waters is formidable, but Agilent wins the tiebreaker through its broader portfolio, specifically its strength in gas chromatography and spectroscopy, and most importantly, the massive differentiator provided by the comprehensive global service network of the CrossLab Group. Waters simply cannot match that in scope or scale.
So synthesizing Chapter 1, the verdict on business quality seems pretty conclusive.
It is. Agilent is a classic high-quality compounder. They sell mission-critical tools into a regulated environment. They have regulatory enforced high switching costs. They're protected by massive scale. And they're successfully building out a sticky, recurring revenue base, all aligned with favorable secular growth trends.
Chapter 2, management evaluation. Now that we understand the quality of the business, we have to assess the people responsible for steering the ship. Even the most structurally sound business can be run into the ground by poor stewardship.
And this is a timely evaluation, given the recent leadership transition. Padraig McDonnell took over as CEO in May 2024.
He's a total insider, an Agilent lifer who started his career out in the field. What does that 25-plus-year internal tenure signal to investors?
It signals continuity, deep institutional knowledge, and a strong culture fit with that HB ethos we talked about. But crucially, before taking the top job, McDonnell led the Agilent CrossLab Group, the ACG, the Services and Consumables Division.
Wait, stepping back for a moment, that is a powerful strategic signal from the board, promoting the head of the annuity stream, not the head of instrument sales.
Exactly. The board is unequivocally stating that Agilent's long-term future and value creation are rooted in optimizing the customer lifecycle, maximizing those high-margin recurring revenues, and deepening the integration with the customer base. It's not about prioritizing cyclical hardware sales.
So McDonnell is the executive most responsible for building the structural resilience we just discussed.
He is, and his tenure since May 2024 has been a baptism by fire. He's had to navigate the 2024 destocking cycle and now the 2025 tariff wars.
And how has he performed under pressure?
Exceptionally well, particularly when it comes to transparency. In this environment, institutional investors value candor above all else. In the FY 2025 earnings calls, McDonnell and the leadership team didn't try to spin the China slowdown or downplay the margin impact of the tariffs.
They just laid it out.
They quantified the hits and provided clear, multi-year mitigation strategies. That operational rigor aligns perfectly with the foundational HP way culture.
Let's move to the ultimate litmus test of management quality, capital allocation. How disciplined are they in deploying the significant free cash flow this business generates?
Their approach is what they call balanced capital allocation. They prioritize high-return organic reinvestment, which is R&D, followed by disciplined M&A, and finally, consistent shareholder returns through buybacks and dividends.
Let's examine the buybacks. Are they buying back stock aggressively to artificially inflate EPS, or are they being disciplined?
The latter. In FY 2025, they retired 3.0 million shares for $374 million. That results in a buyback yield of just under 1%. It's a programmatic approach, primarily used to offset the dilution that comes from issuing stock-based compensation to employees.
So no aggressive value-destroying buybacks at elevated prices.
No, they're focused on steady maintenance. They also maintain a dividend, although it's quite small.
It's a token dividend, yeah, yielding about 0.70% as of January 2026.
It serves as a consistent promise of discipline and cash return to shareholders, growing steadily year after year. But the core investment thesis relies entirely on capital appreciation, driven by underlying operational expansion.
Let's talk M&A. Danaher is famous for large-scale, transformative mergers. Agilent, conversely, seems focused on smaller, niche acquisitions.
They meticulously avoid the bet-the-company mega mergers that often derail integration and create massive risk. They adhere strictly to what they call the string of pearls strategy.
Right.
They target small, niche technology acquisitions, perhaps a focused AI software player to accelerate the Ignite strategy, or a specific capability in the CDMO space like BioVectra.
And the value arbitrage here is significant, right?
It is immense. They can acquire a piece of high-value specialized technology, and because they have that vast integrated global sales network serving 285,000 labs, they can immediately plug that acquisition in and scale it instantly. This generates rapid returns and, critically, keeps the integration risk profile low.
Which is a key benefit in a high-interest environment where M&A debt is so costly.
Absolutely.
I have to challenge this point, though. While low integration risk sounds good, is there a risk they are too conservative? If Thermo Fisher or Danaher makes a truly transformative acquisition, could Agilent get left behind by refusing to engage in necessary large-scale deal-making?
That is a fair and important challenge. The risk of conservatism certainly exists. However, Agilent's historical success has been built not on being the biggest conglomerate, but on being the best integrated platform in core analytical chemistry. They believe their competitive edge comes from the seamlessness of their workflow, not the sheer number of brands they own. If they were to pursue a massive merger, they risk compromising that integrated workflow advantage. For now, the string of pearls model serves them well.
Okay. Finally, let's touch on incentives and culture. Are the executives' goals aligned with shareholder value?
Yes, executive compensation is clearly aligned, tied directly to adjusted earnings per share and total shareholder return, or TSR. Their primary operational focus right now is efficiency through that Ignite strategy.
Which is targeting between $75 million and $80 million in hard cost savings.
Exactly, and that's a crucial initiative designed explicitly to combat the external margin pressures we're about to detail in the financials.
So the overall verdict on the management team?
They are rational operators. They are not chasing headlines. They are focused on operational rigor, capital discipline, and maximizing that high-margin customer lifecycle. They pass the stewardship test with high marks.
Chapter 3, Financial Health. We now open the hood on the engine room. In this high interest rate environment, financial strength and margin resilience are everything. We are examining the results for fiscal year 2025 and the guidance for 2026.
Let's start with revenue resilience. Full fiscal year 2025 revenue came in at $6.95 billion. That's a reported growth of 6.7%, with core growth stripping out currency and M&A of 4.9%.
That 4.9% core growth is the true organic pulse of the business, and its return is significant because it marks a clear reversal.
Absolutely. The preceding fiscal year, FY 2024, actually saw revenue decline by 4.73%. That swing confirms that the underlying market demand for analytical instrumentation has normalized and is back on a steady growth trajectory.
So the market downturn was cyclical destocking, not structural erosion.
That's right. Now let's pivot to the friction point, margins. This is where the chaotic external environment of 2025 really left its mark. Gross margin for FY 2025 came in at 52.4%.
Which is a noticeable 200 basis points down from the historical highs we're used to seeing from Agilent.
And our source material is highly specific about the cause. This margin pressure was explicitly driven by higher tariffs and shipping costs, a direct consequence of the complex 2025 trade adjustment policies. Agilent was forced to absorb higher duties on key components.
That 200 BPs hit is a major, tangible structural tax on the business. How is management planning to combat this persistent headwind?
They are responding with urgency and a multi-pronged approach. Management is guiding for a 75 basis point expansion in operating margins for FY 2026.
Okay, how do they get there?
They plan to achieve this through two main levers. First, Aggressive execution of the Ignite cost savings program, targeting that $75 to $80 million in efficiencies. And second, demonstrated pricing power.
Pricing power is crucial. Can they really raise prices sufficiently without losing volume to competitors like Thermo Fisher?
They can, especially within that sticky recurring revenue stream. Remember the blade, the consumables and services. Since Agilent is often the sole validated source for specific columns, reagents, and compliance services, they have the ability to raise prices on those essential items to offset tariff absorption in the hardware segment.
And the customers will pay because the regulatory switching cost is too high to risk a change.
Exactly. The cost savings program gives them room to maneuver, while pricing power ensures that tariffs aren't simply passed through to the bottom line without mitigation.
Okay, what about earnings?
Moving to earnings per share, FY 2025 non-GAAP EPS was $5.59, representing 6% growth. For FY 2026, management guided for non-GAAP EPS in the range of $5.86 to $6, implying 5% to 7% growth.
That projected growth rate seems somewhat subdued for a company we've deemed a high-quality compounder. Is this a sign of an operational slowdown?
This is a perfect example of a reported number masking a better operational reality. The crucial context here is the tax rate. Agilent's underlying operational earnings growth is actually pushing into the high single digits.
But the FY 2026 EPS number is being structurally dampened by a rising projected tax rate.
Right. What's driving that tax increase are new global minimum tax rules, specifically related to the OECD's Pillar 2 initiative. Agilent's tax rate is projected to rise significantly to 14.5% in FY 2026.
So if you normalize for that, the growth is stronger.
If you normalize the tax rate, the underlying operating momentum would suggest a growth rate well above the reported 5–7% range. This is an accounting headwind, not an operational one.
Okay, let's talk about the balance sheet, the ultimate insulator in a challenging financial market. With the 10-year Treasury yield sitting at 4.17%, leverage is dangerous.
Agilent's financial standing is exemplary. It's an impregnable balance sheet. They hold cash and equivalents of approximately $1.79 billion against total debt of about $3.05 billion.
Which results in net debt of only about $1.26 billion. With estimated EBITDA around $1.8 billion, their net debt to EBITDA ratio is well below 1.0x. That low leverage must be a massive competitive advantage right now.
It is paramount. It insulates them entirely from the pain of high interest expenses that other, more indebted industrial peers are currently suffering. Furthermore, that combination of low leverage and nearly $1.8 billion in cash gives them substantial dry powder.
So if volatility or stress in the market forces competitors to sell assets cheaply,
Agilent is perfectly positioned to make opportunistic acquisitions without having to tap expensive debt markets.
that brings us to the core valuation exercise, determining the intrinsic value. We ran a discounted cash flow, or DCF, analysis. To start, we had to normalize the free cash flow. Why?
Reported free cash flow for FY 2025 was $1.152 billion, which looked a little weak. This was temporarily depressed due to some timing issues related to working capital and a strategic inventory buildup they took on in anticipation of the new tariff risks.
So to get a realistic baseline,
We normalized the starting free cash flow to $1.3 billion, which reflects a more typical healthy conversion rate from their earnings.
now let's discuss the growth assumptions. We used 8% free cash flow growth for the first 5 years, then a 3% terminal growth rate. That 8% seems aggressive for a company fighting tariff margin pressure and tax headwinds. Why not something more conservative, like 6%?
That is a critical challenge, and it goes back to the underlying operational thesis. While revenue growth is guided lower, the 8% free cash flow growth accounts for two things. First, the higher margin mix shift toward the cross-lab annuity stream, and second, that management-guided 75 basis point operating margin expansion driven by the Ignite cost savings.
So the 8% reflects the expectation that management successfully executes those initiatives.
It does. If they fail to execute the cost savings, the 8% becomes unattainable, but our DCF has to reflect the execution of the explicit guidance provided by the company.
Understood. What about the discount rate, the WACC?
We calculated the WACC at 8.25%. This incorporates the current higher 4.17% risk-free rate and uses the calculated equity beta of about 0.95. We are applying a real current cost of capital to the cash flows, which yields more rigorous conservative valuation.
So after running those rigorous yet achievable assumptions, the model results in an implied intrinsic value per share of approximately $140.
Correct. And with the current price at $144.92, the stock is trading about 3% of 4% above that conservative estimate. This confirms our initial assessment. The stock is in fair value territory.
It's not a bargain, but the quality of the business seems to justify a slight premium over a pure-play conservative model. The market is pricing in slightly higher growth or better execution than we assumed, but not by much.
Exactly. For a business with such structurally durable competitive advantages, paying a small premium over intrinsic value is often required, but it necessitates buying with discipline.
Like and subscribe to Stock Analytics AI.
Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings. Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.
Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment. We know what the business is worth on paper, but how is Mr. Market reacting to Agilent right now?
The current Wall Street consensus is broadly constructive. It suggests a belief in the fundamental quality, but is far from euphoric. The analyst breakdown shows a clear bias toward quality. 13 buys, 7 holds, and 0 sells.
That absence of sell ratings is a significant quality indicator. No structural weakness is anticipated by the street. What are the price targets reflecting?
The average 12-month price target is approximately $170, with the lowest target being $150.
This is interesting. The current price of $144.92 is actually below the lowest analyst target. That suggests that low expectations are already baked into the stock price, giving us a psychological margin of safety.
Precisely. If Agilent simply meets its guidance and executes the Ignite strategy, there's inherent room for upward re-rating just to hit the low end of consensus.
We also check the short interest to gauge what the so-called smart money is thinking.
The short interest is negligible, sitting at about 1.17% of the float. This is a very clean signal.
The bears see no structural thesis to bet against. No liquidity issues, no fraud, no imminent obsolescence. They're simply not interested in tangling with a company protected by such high switching costs.
Correct. It confirms that the financial foundation is sound and the competitive position is robust.
Finally, let's look at the comparative valuation gap. Agilent is currently trading at a forward price-to-earnings multiple of about 25 times.
And this is where the opportunity for expansion lies. Peers like Thermo Fisher typically trade closer to 27x, and Danaher commands a multiple of around 30x.
So Agilent trades at a discount.
It does for a few reasons, primarily the perceived cyclicality of the instrument segment and the fact that their M&A is less aggressively transformative than Danaher's. So if management successfully executes the Ignite strategy,
proving that the cross-lab services and digital intelligence can accelerate core organic growth,
the market could reward them by closing that valuation gap. If they can sustain high single-digit growth and realize the guided margin expansion, the market multiple expanding towards that 27x or 28x range is a very real possibility.
Which would generate significant shareholder returns even without massive earnings upside surprises.
Exactly.
Chapter 5, Ownership Structure. Let's see who is actually holding the stock, because the composition of the shareholder base dictates how the stock will behave during periods of stress.
Agilent structure provides immense stability. It is dominated by institutional players, forming what we could call an institutional base. The big three, passive managers, Vanguard at about 12%, BlackRock at 9%, and State Street at 4.4%, collectively own well over 25% of the shares.
A massive block of stability. These index funds are not sellers based on quarterly noise or a mild recession.
They are permanent, passive holders. This large ownership block provides a significant reduction in volatility and, critically, a very strong price floor. Their presence effectively validates Agilent as a true blue-chip holding.
The kind of durable company large funds require.
We also see validation from quality long-term active managers, such as Wellington Management, holding around 3.3%. Their presence confirms that even investors who do deep active diligence on the fundamentals support the quality thesis. They are buying the durability.
Now, the yellow flag we have to discuss. Insider ownership. It is remarkably low.
Yes, Agilent scores poorly on classic alignment tests. Insider ownership is less than 1%. This is a material negative when you evaluate management alignment, as we generally prefer executives whose personal wealth is significantly tied to the long-term success of the stock.
And we noted insider selling activity in late 2025 and early 2026, including from the CEO, Padraig McDonnell, who sold 5,500 shares. Does this concern us given our fair value assessment?
We have to apply some nuance here. In a large established company, executives receive significant stock compensation, and selling for personal diversification, house purchases, or tax payments on vested options is standard practice.
And often scheduled well in advance.
Right. The true litmus test is not the selling, but the absence of buying.
Hmm.
We have not seen any meaningful open market buying recently. No executive writing a personal check to buy stock because they think it's materially undervalued.
The lack of open market purchases reinforces our valuation view.
It does. Management likely views the stock as fully priced at $144.92. They are happy to hold, but they aren't seeing a generational bargain.
Chapter 6. Risk Assessment. For a high-quality compounder, the risks are rarely existential, but they are focused on operational friction and margin erosion. We need to triage the threats Agilent faces in 2026.
Our analysis identifies the 2025-2026 tariff regime as the primary threat. Tier 1, high impact, high probability. This is not a theoretical risk. We saw its quantifiable impact on Q4 2025 gross margins.
Let's get into the specifics of the new Section 301 tariffs. What exactly is being targeted that impacts Agilent, and how deep is that financial hit?
These tariffs, enacted in 2025, target Chinese imports of key components and medical devices. Now, while finished pharmaceuticals were largely spared, inputs critical for analytical instruments were not. We're talking about components like complex electrical circuits, specialized permanent magnets used in sophisticated mass spectrometers, and lithium-ion batteries that power portable systems.
And the immediate financial consequence
Was a material 100 basis point hit to gross margin in Q4 2025 alone. Furthermore, the outlook for 2026 is structurally concerning, as duties on some key inputs are scheduled to increase even further. This creates a persistent structural tax on Agilent's production costs.
How exactly is Agilent mitigating this? Moving manufacturing facilities isn't a quick or cheap decision. What is the timeline and cost of their mitigation strategy?
This is a multi-year project requiring significant capital. Agilent is accelerating the relocation of key component manufacturing from China to facilities in Singapore and Malaysia. The timeline for full capacity transfer is projected to run well into fiscal year 2027.
So it's a slow process.
It is. They expect this supply chain optimization to gradually mitigate the tariff headwind, aiming to reduce reliance on the affected Chinese supply chains by roughly 30% by the end of 2026. This transition is costly, but it is essential to restore the gross margin back toward that historical 54% range.
Yeah, until then.
Until then, they must rely on the second lever: aggressive, disciplined pricing increases on the sticky consumable side.
Let's move to the second major risk, the China structural slowdown. This is a Tier 2 risk medium impact, high probability. China was a massive growth engine, and now it's actively shrinking for Agilent.
China revenue declined 4% in FY 2025, and management is rightly guiding for flat growth in FY 2026. The problem is twofold: cyclical weakness in government spending, compounded by policy-driven structural headwinds.
Elaborate on the policy-driven part. We're talking about the Made in China 2025 initiatives, right?
Precisely. This state-backed policy explicitly aims to increase domestic technological self-sufficiency. This means the Chinese government is actively prioritizing and often heavily subsidizing local domestic competitors in certain segments of the analytical instrument market.
And this substitution is happening most aggressively in the low to mid-range markets.
Exactly. For example, simpler spectrophotometers or basic gas chromatography systems. Local players like Skyray Instrument or Focus Scientific, backed by state funding, can offer functional alternatives at significantly lower prices.
So Agilent's regulatory moat only protects the highest-end, most complex and critical machines used in pharmaceutical QC.
Correct. The complexity of a high-resolution quadrupole time-of-flight mass spectrometer still requires Agilent or a handful of Western competitors. But in the mid-range analytical lab, Agilent is seeing structural erosion. Management's expectation of zero growth from the China region in 2026 is prudent.
Any upside is a bonus.
We have to model this market as structurally challenged for the foreseeable future.
Finally, technological disruption. Our Tier 3, risk high impact, but low probability in the short term. This is the black swan that could theoretically render their LC-MS systems obsolete.
The threat is real but distant. Could entirely new techniques like advanced proteomics on a chip systems or ultra-fast nanopore sequencing eventually replace the need for massive, expensive benchtop LC-MS instruments? Yes. The pace of scientific discovery is relentless.
So how does Agilent hedge against this fundamental technological risk when their core competency is decades-old analytical hardware?
Their mitigation strategy is brilliant, and it ties back directly to the Ignite digital pivot. They recognize that the most durable part of the lab is the data.
Hmm.
So they hedge by focusing on owning the data layer and the data pipeline.
So their investment isn't just in the next generation of hardware.
No, it's in ensuring that whether a measurement comes from their LCMS machine, a competitor system, or a future chip-based technology, the data must flow through Agilent's Open Lab software, be managed by the Agilent Cross-Lab group for compliance, and be analyzed by their proprietary AI tools.
They're becoming hardware agnostic at the data level.
Yes, this makes their moat based on regulatory compliance and data infrastructure, which is much more durable than any specific piece of hardware.
Chapter 7, Conclusion. We have navigated the structural quality of business, the discipline of management, the resilience of the financials, and the very real external risks posed by tariffs and geopolitical shifts. It is time for the final synthesis.
Okay, let's synthesize the core arguments. The bull case rests on 4 pillars. We are buying into a near-monopoly position in the essential Agilent Cross-Lab group, which provides reliable, high-margin annuity revenue.
Right.
The critical pharmaceutical CapEx cycle is definitively restarting. The balance sheet is impregnable, providing safety and strategic optionality. And management is actively executing a digital strategy designed to deepen stickiness and accelerate margin expansion.
And the bear case.
The bear case warns that tariffs are a persistent structural tax that requires constant expensive mitigation. The valuation at 25x forward PE is fair, but leaves little safety margin if that Ignite execution falters. And the China market presents a persistent, decade-long structural headwind due to state-backed substitution.
So how do we weigh quality versus valuation? We return to the long-term inevitability test.
We have to ask 2 questions over a 10-year horizon. 1, is it inevitable that the world will require more testing, more environmental analysis, more food safety compliance, and more complex drug development? Yes, absolutely.
And 2,
2, is it inevitable that major pharmaceutical and industrial labs will willingly switch away from Agilent equipment, sacrificing years of validated regulatory compliance? No. The switching costs are structurally too high.
the conclusion is therefore clear. Agilent is a high-quality compounder.
It is the definition of a durable, predictable business built for longevity. However, valuation discipline remains essential. At the current price of $144.92, it is priced for quality and future execution, making it fairly valued.
What is the actionable recommendation for our listener, whether they are a new investor or a long-time holder?
For long-term holders, this is a core hold. Do not sell this compounding engine. For new capital, we recommend initiating a pilot position, a smaller starting size, at the current price of $144.92 to ensure you have skin in the game.
But reserve your largest allocation of capital for the accumulation zone.
Exactly. That accumulation target we are watching closely is $125 to $130. That is the range where the fundamental quality of Agilent meets a compelling margin of safety.
Here is the final provocative thought for you to take away. In a financial world currently obsessed with highly volatile tech and speculative growth, Agilent's quiet, essential, and profitable, boring business model often provides the most durable, lowest stress, long-term returns.
You should challenge yourself to identify which other sectors, be it industrial supply, obscure software, or infrastructure, exhibit similar unglamorous infrastructure-level high switching costs. Those overlooked businesses frequently prove to be the most rewarding long-term investments.
Like and subscribe to Stock Analytics AI.
This deep dive was based entirely on the sourced investment memorandum and AI-assisted research. We are not financial advisors, and this information is not financial advice. Please conduct your own due diligence and consult a qualified professional before making any investment decisions.
Thanks for joining us. We'll see you next time on The Deep Dive.